and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will start by giving an update to my portfolio, and then afterwards I will clarify why I have decided to invest more into Bristol Myers within this week. So let's start with the portfolio update. So the first thing you immediately notice is that there was a red circle for this week's episode, meaning that the value of the portfolio have decreased compared to last week. At the same time, you can now see that the cost has increased. So if we go to the portfolio values tab here, you can see that the portfolio is down $900 compared to last week. And at the same time, the price of the portfolio, or the cost of the portfolio, has increased with a little more than $100. And this is, of course, because I have chosen to invest more than $8,600 into Bristol Myers, which you can see if I scroll to the top here. So now you can see that the invested capital is now $16,688 into Bristol Myers. So I have bought an additional 152 shares within this week. But before we go into the details of this purchase, let me continue to my favorites tab, namely the Dividends tab. And if we zoom out a bit here, then we can see that I have actually not received any dividends within this week, so my total dividends for October will stay unchanged of $508. And you can see here with my newest purchase that my yearly estimate now is back above the $5,000 mark. And if we go back to the overview arc here, then AbbVie has actually announced a dividend increase of 8.5%, so they have increased the dividend from $1.30 to $1.41, meaning that I'm now going to receive $14 additional every single quarter just by holding the stocks. So with that big increase to the dividend, then it brings my estimated yearly income above $5,200. I mean, this is really the dividend growth investing strategy taking place right in front of your eyes. I try to invest in companies which I believe will continue to grow and therefore will continue to increase their dividends. So just as a final remark here on the portfolio update, you can see that the healthcare sector now makes up more than 40% of my portfolio. And I am comfortable with this risk. I'm not saying that you should be, because there are naturally a lot of risks associated with investing into pharmaceutical companies, which I will try and go through when I go through my latest purchase of Bristol Myers, which we will take a closer look at now. So if we start the analysis of Bristol Myers by explaining my history with this company. So if we go back to December last year, more specifically the 29th of December, this is where I made my initial purchase of Bristol Myers. So that means that I have bought my first shares at around the $61 mark. And if we then look at the latest week, well, Bristol Myers came out with their quarterly result on the 27th of October, and as a result, their stock dropped more than 3% at the day. And this was where I decided to invest more into the company. Unfortunately, I of course didn't hit the rock bottom on that particular day, but I managed to get in just below $57. So a very natural question to ask at this point in time is, of course, well, since you initiated your position at the end of 2020, where you bought at a little more than $61 and you have had the chance to get out at close to 69, why are you now buying more when the stock is below $60? Haven't this just shown up to be a lousy investment since after a year you are still down? Well, I remind myself of the words from Buffett that the stock market is a way of transferring wealth from the impatient to the patient. And this is why it is so crucial that you understand what it is that you have invested in. If we then continue to Bristol Myers' webpage and take a closer look at the quarterly result, which came out Wednesday, well, we start by noticing that the revenue has increased by 10%, so they are now making $11.6 billion. And it is mainly driven by these three drugs. The next thing that I like to pay close attention to is the research and development expenses. Since we are talking about a pharmaceutical company, well, they make money by selling drugs, and those drugs have patent expiries. And when those patent expires, that means that other pharmaceutical companies or generic pharmaceutical companies can go and sell a similar product, meaning that your revenue or your earnings will be hit severely. So what you need to do in order to stay profitable in the future, well, you need to invest a lot in research and development. So this is always one of the risks with pharmaceutical companies, that they have to invest a lot in order to have a profitable business in the future. So it's always a double-edged sword when you see how much they are investing, because if they have lowered that amount, that means that they could have paid more money into your pocket today, but at the same time, you have to realize that perhaps it is a good idea that they actually invest a lot to be able to continue to pay you a lot in the future. And speaking of the future, if we then continue down here to look at this revenue table for the different drugs that they're currently selling, then it becomes very clear why they mention these three as the main drivers for the revenue growth, since you can see by the numbers here how much they have contributed. But what I like to pay close attention to is the percentage change over here between the different drugs, because this is really one of the risks that you need to understand with pharmaceutical companies. For instance, if Opdivo has a patent that expires in a year from now, and they have around 20% of their revenue coming from this particular product, well, of course it will heavily affect the revenue of the company. So that is a thing that you need to take into consideration when you evaluate how much you're willing to pay for the stocks of the company. And perhaps as equally important, what is the company actually guiding? So if we continue down this quarterly report and scroll all the way down until we find financial guidance, we can see that previously they have guided between $2.77 to $2.97 per share, and now they have lowered that expectations to $2.68 to $2.83 per share. So this is one of the things that investors really do not like to see when they have lowered their expectations for the future. So this could be one of the explanations for why you see that the stock actually dropped around 3% on the day when this quarterly report was announced. And if we, for instance, go to Yahoo Finance, well, there we can see that there's actually no PE ratio, since the earnings per share are negative. That does not look too good. This is a severe red flag. So if we scroll down here, we can see that the earnings in 2020 was actually negative by 9 billion. So we have to look for an explanation to this. So in my research to try and figure out why there's negative earnings for 2020, well, the best place to search for such an explanation is inside the annual report. And lo and behold, if you go to page 15, then you see this IP&RD charge, which is short for in-process research and development charge. Since they bought MyoKardia, and that acquisition had to be listed as an asset, so that means if we continue further down here, that they actually paid 11.4 billion for this MyoKardia acquisition, and it had to be listed as an asset, meaning that the earnings were subtracted these 11.4 billion, so the earnings was actually positive before this acquisition. So that is actually a very, very good explanation. If we then continue to macro trends, just to get a better overview for some of the more historical data, just to see how the company has performed, well, if we look at the revenue here from 2011 and all the way up to 2020, we can see that it has been steadily increasing since 2014, and we can see that there was a major jump between 19 and 2020. And just to make sure that what we saw in Yahoo Finance was not wrong, well, we can also look at the net income here and see that for 2020 it was negative by 9 billion, so that is confirming the data which we just saw in Yahoo Finance as well. If we then continue to the balance sheet, well, then we can also very clearly see that total assets has increased quite significantly. This is of course due to the acquisition of Celgene as well. And that means that their liabilities, meaning that they have much more debt since they have also acquired the debt from those companies. So, I mean, nothing comes as a free lunch. When you buy a company and you also take over the debt, well, you will also see that the debt is increasing. But what I like to see here is that total assets is still way above total liabilities. So you still have a quick ratio above 1. So this was just a different way for me to illustrate why I have chosen to invest into Bristol Myers. And the reason why I didn't go through my regular guidelines was there actually was a new learning point here. Since if you just look into Yahoo Finance, you could have seen that there was negative earnings and that would have kept me away from investing into this company. But when we then looked closer at the annual report, we could see that there was a very good explanation due to this in-process research and development cost, and I have not shown such a thing on this channel before. And when we then take into consideration the quarterly result, we saw that they have revised their numbers or guided lower expectations. Then you could immediately see that the stock dropped based on that announcement, and I took the opportunity to buy since I still believe in this company. Since when they can grow the revenue with 10% and they are trading at a PE ratio of less than 8, well, then I am willing to put my money there and wait and see whether or not I will actually get paid for it. Since I think there is quite a margin of safety for this company, because I would believe that the stock should trade at a PE ratio of around 15, indicating that it should roughly trade around $115. But whether or not we will ever see Bristol Myers trading at around $115, of course depends on what they are capable of delivering in the future. And the only thing you know about the future is that it is uncertain. But I am willing to be patient and see if that actually pans out. So that sums it up for yet another exciting week of the Lazy Money Game. So if you enjoy content like this, then please consider leaving a like or leaving a comment or subscribing to the channel. It really helps me out. And until I see you next time, bye!